Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. My guest this week is Max Gonzales. Max, thanks for coming on the show. Let's get you to give a little bit of a background, what your story, who you are, just for everyone who's listening.
Sure. So Max Gonzales, and I'm an investor in multifamily real estate. I've been in the industry for about 17 years. Started out my career as a broker, moved into acquisitions. Most recently, I left the corporate world to pursue my own portfolio. I placed large pots of capital into the market for some very large institutional partners. And it was a great run. I loved doing it. I learned an immense amount about the industry, about how capital flows down from some of the largest institutions down into the market, how a lot of those groups, evaluate real estate, how they decide, what qualifies for a particular return that they need based on a particular asset's risk profile, and, and how they evaluate buying assets based on coupon. And, and going through and having that corporate experience also was great, because it also really motivated me to say, hey, you know what, if I want to build my own portfolio, you can't do it working for, a large organization. Large organizations have fantastic training. They teach you an immense amount. I mean, I've got some truly invaluable experience and some truly invaluable, and maybe invaluable is not the right word, but relationships that, I just couldn't put a dollar amount on from having, this experience with some really top level people within the industry. And, then more recently decided to go on my own, get my own investors, raise capital to do our own deals. And that's been an absolutely fantastically rewarding experience, just on so many different levels. And that's my introduction. Brief history. I've probably transacted on a little over 3,200 units over the last 4 years. I've probably placed about a little over 430 million into the market. And now on my own, working on significantly smaller portions of capital placement, which is great, and something that I couldn't be happier about. So that's my introduction for myself.
That's awesome. So I don't know anything about doing this from the corporate side. Maybe we'll tackle that a little bit, and we'll move our way over to the solo side, just follow your story. But you talked about how these big corporations or whoever who's placing this money, do they evaluate the deals differently than how you were doing it now, doing it solo?
The real answer, I mean, in a way, the larger groups, they're going to have a particular capital partner, and a lot of individuals, when they're out in the market, will tell a broker. So brokers say, well, what kind of assets do you buy? And the sponsor, the person buying deals, will say, well, we buy anything. And the answer is they probably don't. They probably buy a very specific type of asset, and they buy a particular type of asset that's based on what their capital kind of allows them to purchase.
Yeah.
And what I mean by that, just in getting a little more granular, is, everything's available for a price. And most of us would say, oh, if this deal was cheap enough, I would, in fact, be willing to purchase it. But then we find out, as we get into the bid process, that the aggressive offers are the ones that really fit that particular asset's, return profile for what it would be if it's a core building. It's a newer build, something that has lower maintenance and magnitude of the scale in regards to how much work you're going to have to do to manage the building. It's going to have a lower return. If it's a more heavy lifting, it's a heavy value add, you expect a higher return. And those metrics are generally the same within the corporate world down, but they get more and more divided. And they get really divided because if you've got an institutional bucket of capital, whether it's a life insurance company, a pension fund, a credit union, maybe a high net worth, family office that has, 100 billion or something more, their diversification of their portfolio is significantly larger than just real estate. And they're risk adjusting the entire portfolio on more than just, that one particular asset class. So if you take, I'll call it, we'll use a smaller number, but $100 million. Well, no, we will use 100 billion, because that's about the size of the institutional portfolio size. And they're going to take 40% of that, and they're going to allocate that towards stocks. They're going to take another 20% of that, and they're going to allocate that towards bonds. And then they've got this other 40% they're going to allocate towards, I'll call it 30% in real estate, and maybe another 10 towards alternative investments. But if you were to take that 30% real estate and expand it and look at it even closer, well, then you'd realize that they actually have a portfolio that's for multifamily. industrial, maybe mini storage, maybe ground up, and depending on what experience level that particular group has, they're going to be able to decide how they want to deploy that capital. And their experience level is also going to say that they're not just going to place the money, but they're going to hire a fund manager to manage those individual accounts for them as well. So if you take the multifamily account and you expand that, well, then you might look at it and find out they've got a fund manager for the East Coast, a fund manager for the West Coast, and those might even be segmented further depending on the age of the asset and the profile of the building. So the value add fund manager might be different than the core plus fund or the core fund manager, because those are different management styles. The groups that are good at placing capital to buy an A-class building in a downtown metro market that's brand new is going to be a different type of capital structure and management profile than is a heavy value add that's going to be located in a tertiary market where they're going to have to go in and spend $15,000 to $20,000 per unit to get a $150 to $200 rent move on a particular multifamily unit. So those groups, with how detailed they get and how they decide which particular fund managers they want to allocate capital, it's a very, very interesting, what I'll really describe as waterfall within the industry, from the top level of money that comes down, and how the top level groups of these institutions are not just looking at how much money they can make on their investments, but also how to risk adjust the returns. Because if you're a pension fund and you're saying, hey, we need to create annuity income for all of our pensioners for the rest of their lives, they care about growing their portfolio, but they care more. I don't know if maybe more isn't probably the right term, but they care significantly about not losing any of that money. So they're going to say, hey, we're going to invest in this particular asset, but they want to really make sure they're hedging their returns accordingly to make sure the portfolio is always growing with the risk adjusted return. So within, how does that compare to, doing things on the smaller side? On the smaller side, regular investors have the same kind of mentality. If I'm going to take a bigger risk, I'd like a higher return. Exactly. It's different in the sense for the individuals who are working on the deals, because when you're working for a large corporation, and this is something that I struggled with when I was, in that world, and then on the outside this is what I've actually really loved. But on the corporate side, it felt for me very specifically that I had stopped growing my knowledge base. And that's not totally true, but it became very, very siloed. You have one particular task, you have a job with an organization, you have to do that job. When you go on your own, you have to raise your own capital, you have to structure your own debt, you have to hire all your own construction crews, you have to do all of the tiny little things that really means you have to wear all these different hats. And I look forward to when we have enough staff to be able to go out and to be able to delegate significantly more of those things too. But at the same time, it's been really fantastically rewarding to have some, I'll call it just new skills under my belt. That whenever anyone does a new venture, if things are easy, you're not pushing yourself enough. So it's been great this year to really feel like I pushed a lot and actually had some fantastic achievements as a result.
Cool. So going from having basically being part of a huge team to creating your own team, and you mentioned that you start by wearing a lot of the hats yourself. Well, how did your business develop? Went from leaving it? How many staff? What people were core people to bring in off the start?
Yeah. So right now it's myself and one partner.
Yeah.
We have a couple individuals that do some individual contract work for us that we've outsourced to make sure that we have. Yeah. Well, I mean, I'll call it contract with dedicated hours.
Okay.
And that's for some specific marketing pieces. We have people who go out to target the market for us. We've got partnerships with different guys in different markets to help allocate deals towards what we're doing and building. And that's something that, I'll say we'll have a better handle on in about 12 months from now, once we have a better sense of how greased the tracks have been within any of those individual, I'll call it roles within an organization. And that's actually one thing that's been fantastic about the previous experiences and I've realized this from working with a lot of guys where, they try to do everything. And I don't want to do everything. In fact, I want to do as little as possible of all the things and be focused on, what I'm good at specifically and oversee the other ones so that it's more managerial than having to really get into the weeds on email blasts or, some particular little, niche sector of something. But but as far as the scale goes, it's got to be organic and also pushed a little bit, both. If groups decide that they want to just hire a bunch of staff right away, but don't actually have capacity or deals to be able to staff those particular roles, then you can end up having to eventually lay people off or not be incentivizing people well enough to do deals. And on the other side with the separation between the corporate world and the private, I'll call it the private individual upstart of buying deals, the pay is just totally different. And on the corporate side, there are groups that pay in equity, but there's a lot of other groups who don't. They pay in bonus. And as a result of the way they capitalize their deals, if their money's coming from some large institution, they might not have a sidecar or an ability to actually take employee dollars or some other investor to be able to put them into an asset. On my side, we can be wildly creative with structuring a deal. We can bring in investors. We can have brokers roll fees in. If I've had guys bring me deals in other markets and they're just individual solo guys, we can work with them to add them into the capital stack of a deal that they have found and have that be their sweat equity piece. And those things are things that have been truly great in regards to being able to work with just really be creative. I mean, real estate is such a creative market across the board. I mean, it's this industry that really is still this industry where whatever you negotiate with the seller of a deal, with the buyer of a deal, with your investors is what you can make happen. And on the large side, that becomes harder. It might not become harder at the biggest level because you are structuring those deals with those large partners. But on the institutional side, it becomes a little bit commoditized in regards to the assets, the returns. There's there are market expected returns that people kind of count on within the industry. And on the smaller side, for myself, we structure what works for our investors, and that will become more defined in time, which I just recognize as organizations grow. Those are things that become more identified. It's just the way of things as things grow and get bigger. But the ability now for us to be able to pay people in ownership of deals is really fantastic. That's something that's just really great.
So what are you guys looking at? So you off the corporate world, you say smaller, like what is smaller?
So smaller assets for us right now are anything between about 2 million up to about 20, and for the most part we're focusing on deals between about 3 million up to 15, and we've got 2 deals in contract right now. One of them is a value add deal in the Phoenix market. It's a series of cottages that are all no shared walls, and it's kind of a fantastic opportunity to go in and create these little casitas for the residents of this community. And the other one that we're in contract in is a asset near UC Riverside in California, and that asset is really well located within what I'll call the path of development for the student population of Riverside. And the building that we are in contract on, it's run down. It's got significant issues that need to be addressed within the exterior of the asset. We need to have it some proper gating created for some more security within the location because it's a transitioning area. Though there's also new buildings on the street that have already been reconverted, completely
That's great.
redesigned for student populations. Yeah. And this particular building really has an opportunity to do better than what it currently is. We've got an ability to get an extra unit out of it. It's a smaller property. It's about 16 units.
Yeah.
And that building is one that I really think is actually, both assets are going to be fantastic when they're actually completed. So we're currently in process of doing capital raises for both, and that's where we are.
So the value add is mostly just fixing up, cleaning up, putting some fences on it, or is there any other?
I mean, to get granular with the value add, it's getting it secured. There's significant deferred maintenance for the exterior of the buildings. We'll probably go in, and we've got about a $15,000 per unit interior budget for the unit insides. Each of the units has a little patio in the backyard, and this particular building is it's a 16 unit asset that's comprised of a 1 3-2 unit and 15 1-bedroom 1-bath units. We're going to reconfigure it so that when it's done, it's 3 2-bedroom 1-bath units and 14 1-bedroom 1-bath units. So we're going to make two of the units larger and add an additional 1.
Okay.
And that opportunity to increase both the unit sizes and get an extra unit out of it and correct the deferred maintenance is going to give us an opportunity to significantly increase the NOI of the property, which for what we do on my side, and I talked to a lot of guys in the industry, some markets, the Phoenix market is a very price per unit focused market where there's so many trades that happen in that market, and there's a lot of value add deals where, hey, I bought this deal for $150 a door. I'm selling it for $210 a door 2 years later because I did this business plan. They might not pay attention to the cap rate very much.
Okay.
They do, but it's also something where people kind of recognize it's a little bit of trading units based on a price per unit analysis, and you have to make sure your cap rates work very specifically for your debt and your debt service coverage. Make sure you've got enough yield to cover those bills. But in California, it's a lot more of a cap rate market. People are buying annuity. And for this particular asset, we're increasing the income of the asset significantly as a result of being able to increase collections at this particular building. And that's done through the renovation scope and making sure that we've got, an extra unit to create an additional revenue stream and all of those other items, the security, the landscaping, the interior unit renovation, the exterior unit renovation, all those things go into raising rents. I want to say about $300 over in place per unit is what we're looking at. I'll have to get the actual specific numbers out to the exact number.
So then the business plan is there to do a refi at year 3 and then a sale. I hear different things from different.
Those options within the structuring of an asset. We've got it underwritten right now for a 5-year hold, which is going to be done on a bridge finance, where we'll most likely do a 3-year interest only, and then at that time most likely refinance. We don't underwrite the refinance because, hey, we don't know. So we say it's dead. We know we're going to underwrite it for a 3-year hold, but if we keep it for 5, this is what the numbers look like. If we refinance it in 3, the numbers look like this. So we'll have a couple different scenarios for what that looks like with investors. And one thing with any of the investors that we have that we're working with is we always, we look at our modeling and we say, hey, here's what the model is showing. But we really remind people that we are investing in real estate. And, in a model is not a crystal ball. It's a calculator that is used to be able to help make business decisions on real world data points. And in so doing, we can show those numbers, but we always remind people, hey, we're investing in an asset. The investment horizon is looking like it's going to be between 3 and 5 years. We're always going to do what's in the best interest of you and your money. And you're going to hopefully receive, I'll call it between a 2.3 multiple on your money and a 2.6 multiple on your money within the horizon of the asset.
Okay, that's what I was going to ask. That was my next question. How you were anticipating for the exit, and then from the investors' side of this, do you pay out? Is the plan to pay out monthly, quarterly?
We like to pay out monthly. We like to pay out monthly, and that actually I would say is a characteristic of also where we are in the building of the organization. We want our investors to know they got cash right away. Yeah, we care. Some groups, hey, start doing quarterly distributions. And I think that's totally fine. I don't think anyone's hurting themselves by any means. We are rapidly trying to let more investors know that we are out there and we are doing deals. And if you want to contact us to invest, please do, and we want our investors telling their friends that they're doing well with us. So, the more times we can touch those investors with, good news regarding, cash flow of the asset and, money in the bank account, the better.
Yeah, no, it's a good idea. And paying monthly does make it, like, if you're getting older people who are trying to live off this stuff, it is a lot easier to live off of. So you mentioned this. So if people are interested in this, how do they track you down to find out what's going on with your fund?
Yeah, the best way is geometricre.com. We don't have a fund. Okay. we do each deal as an individual syndication. Yeah. Down the road, we could do a fund, but for the time being, we just do one asset at a time. Yep. But website is geometricre.com. And we've got a beginning investor starter guide that's on there. And that's been something where a lot of guys call me up and they want to get into the industry. And that particular guide is really designed to help people kind of see how many different sectors there are within the industry. My focus is multifamily, but people don't realize how much money people make in entitlement, ground up development, core assets, value add assets, core plus assets, and then those segments can also apply to, multiple different product types, from industrial to office to retail to even further divided, topics like medical office or, big box industrial or, triple net retail. And we've got a starter guide to kind of help people kind of figure out where they might want to be. A lot of people who have, W-2 careers are actually somewhat touched to real estate already. They might not know it yet, but they live in a house. They might know some house on their street that could be flipped. Maybe they work for a corporation that has some particular segment of real estate holdings, and they might know a little bit more about them than they realize.
Mm-hmm.
And I get a lot of guys who call me up to say, hey, where do I start in the industry? If you want to start in multi, if you're anywhere in the country and you say, hey, I want to get involved, reach out to me. I'd love it.
Yeah.
On the website, geometricre.com, we've got links to get in contact with me, and I'd love to have conversations with anyone who's looking to invest, get into the industry. If you're in some market and you're saying, hey, I found this deal, but I don't know how to capitalize it, and I want to work with some guys who've done this, reach out to me. Those are people who I love being in contact with.
That's a great offer. Max, before I let you go.
No, you're totally fine.
But Max, before I let you go, is there any questions I should ask you that I kind of slipped by there?
No, we've covered a lot. If there's anything within any of the topics we've covered that you want to go into on a deeper level, more than happy to jump on another call.
Yeah.
And happy sharing knowledge regarding whatever I can in regards to the space. I love being network with people and sharing knowledge and being able to work with guys who are hustling. And that's what I like about the podcast community, the guys who are listening to these. People who are taking the time to do self-education, to figure out how to advance their careers, are all people who I want to be networked with across the board. So if there's any time that you've got additional questions you want to discuss or go over, reach out. Love it.
That's great. Thanks. And thank you for offering that to everyone listening. Thank you for coming on the show, Max. It was a lot of information. There was a lot of information that I'll have to almost listen to it a second time to go through it all. But thank you so much for coming on the show.
Absolutely, Glenn. Reach out anytime, and we'll hopefully talk soon.